ISA allows you to legally save and invest up to £20,000 and never pay tax on the dividends, the capital gains, and also interest on this amount of money. When you decide to buy an Apple share, it is currently about in hundreds of pounds. These fintech companies allows you to buy shares as low as £1 worth of share. It's almost the end of a tax year and the beginning of another one. Let's talk about a £20,000 allowance tax-free that you might be missing out on. Every tax year, ISA allows you to legally save and invest up to £20,000 and never pay tax on the dividends, the capital gains, and also interest on this amount of money. So guys, what is ISA? ISA basically means individual savings account. Pick 4 different types of ISA, and that is cash ISA, stock and shares ISA, LISA account, and then there is innovative ISA. So when it comes to cash ISA is actually quite similar to regular savings accounts in that it is offered by banks and building society, and your money is protected by the Financial Commission. However, like I said, it is tax-free forever. So compared to the regular savings account where you have to pay interest when you start earning when you start earning interest up to £500 to £1,000 based on your tax rate. So you see, this one allows you to earn enough interest and don't have to pay tax on it. So now, before you decide to go for a cash ISA, because the interest rate is not always as much as that of the regular savings account, it is worthy to take note of these 3 things. And that is: first, are you paying interest on your regular savings account? 2, do you think you might be close to paying interest on your savings account? And 3, are you an IRS taxpayer? That is, are you paying between 40% to 45% tax? So because when you're paying this, you only have £500 on your personal savings account. So these 3 things are worthy to take note before you decide to go for a cash ISA. When it comes to cash ISA, because you have £20,000 over the year across all your ISA accounts, it is worthy to take note that while choosing your cash ISA account, you need to be sure if the account is flexible or not. Come with me, because let me explain this. Because when it comes to flexible accounts, it means when you have your £20,000 in the whole year and you pay in £10,000, then after paying in this £10,000, you decide to withdraw £3,000. If your account is flexible, you would still have the £10,000 which you have not deposited at all. Then you would also have the £3,000 which you have taken out of the account. However, when your account is not flexible, all you would have left is the £10,000. That means you've lost the £3,000 ISA allowance that you would have for the year. That means you'd be left with only £17,000 across your ISA account. Alright, also, like the regular savings accounts, there are different types of cash ISA. Like we have the regular savings ISA, then we have the fixed deposit ISA. So the current rates for regular savings ISA rate is about 3%, while that of the fixed deposit cash ISA is about 4%. Before you decide to choose any of this, it is worthy to take note of the 3 things which I've earlier said, which would be a determinant if you should go for a cash ISA or just a regular savings account. So now, moving on, let's talk about the stocks and shares ISA. This is the juicy one, because with this one, you're limitless. You can multiply your interest. However, as much as the benefit of multiplying your interest, like multiplying your capital, you are also at high risk of losing your money. So you need to be careful with this, and you need to do your due diligence. So now, what is stock and shares ISA? Stocks and shares ISA basically allows you to be able to invest your money by buying part of a company. Like, yes, you become part owners of a company. So Under the stocks and shares ISA, you can either decide to buy shares or to buy bond. Now, what is the difference between shares and bond? Shares allows you to own a part of a company, while when it comes to bond is a loan to either the government or to a company. So that's the difference between shares and bonds. When it comes to investing in shares and stocks, you can either decide to do it yourself or go to companies to invest on your behalf. They decide on based on your age, your risk appetite. They select companies for you, they select funds for you to invest in. So now when it comes to doing it yourself, there are some platforms available for you to help you do it yourself. I can always do a video on platforms that are available for you to have a look, for you to read, because if you go to companies to invest on your behalf, the charges that they'll probably take from the money would weigh whatever dividend or whatever profit you're getting from the investment you're doing. So for doing it yourself, there are two common fintechs that allows you to invest in stocks and shares from your house. Like, you don't even have to know where Wall Street is. You don't have to know where Custom Street is, which is the one for back home in Nigeria. So you don't need to know where exactly the stock exchange platform is. All you need is this fintech platform, and it allows you to invest in fractional shares, which is a very good advantage. For instance, a number of persons use Apple. So if you decide to invest in Apple, because a number of us use iPhones, we use Mac, we use iWatch, we use all these Apple gadgets, we subscribe to Apple TV, Apple Music. So for us to be able to get our own percentage of this interest of this business, the best thing to do is to buy an Apple share. So when you decide to buy an Apple share, it is currently about in hundreds of pounds. I'm not sure exactly the figures. So let's say, for example, it is currently in hundreds of pounds. These fintech companies allows you to buy fractional shares. For instance, you can buy shares as low as £1 worth of share. You can buy £10 worth of share. You can buy £5 worth of share. Like, there's no cap to how much you can buy. There are two common ones that I know. I know of Trading 212. Trading 212 allows you to buy shares of company, and it also exposes you to funds that are available. Like, these funds are a mixture of different companies, so it exposes you to that. However, there is another alternative which I know a number of persons are currently using, because I use Trading 212, and that is Vanguard. Now, the only thing with Vanguard is the fact that they only offer their funds. Like, you can only be exposed to their funds on their own platform. So you can be exposed to Vanguard's S&P 500. So those are the things that you are able to be exposed to. It has to be their own fund. So for me, I prefer the Trading 212 because it allows me exposure to a number of funds, and also to be able to buy fractional shares. So moving on, if you want to buy your first house, like you don't have a property yet, and you want to buy your first house in United Kingdom, my very advice for you is to open a LISA account. Like, open a LISA account. I am begging you, please open a LISA account now. LISA simply means Lifetime Individual Savings Account. What does it do? So basically, what LISA does for you is it offers you, it's an account that offers 25% bonus every tax year. Like, yes, every single tax year you get 25% bonus on LISA. So because the government is offering you 25% bonus on LISA, there are more stringent rules on LISA. For every other types of ISA, you can decide to put in your £20,000 at once into every of these accounts. The government does not mind. They don't even look at your side. But you see, when it comes to LISA, you can only put in £4,000 every tax year, which means for every £4,000 you put in a tax year, you get an extra £1,000 on top of it. So to be able to open a LISA account, you have to be between the age of 18 to 40 years old, and you can put in money into a LISA account every tax year up to the point where you become 50 years of age. So the government specifically wants you to be able to use LISA. Like there used to be another one which is called Help to Buy, but this has been phased out and LISA is currently the in thing. So to be able to use a LISA account, there are only 3 ways in which you can withdraw your money, and that is 1, to buy your very first home. The second one, when you are 60 years and above, and the third one is for a person who is currently sick and probably has less than 12 months to live. That is the only third condition to be able to withdraw from LISA. Now, under these stringent rules, people are like, these rules are a little bit strict. But yes, come to think of it, 25% is a lot of money. So if you want to buy your very first home, open a LISA account today, please. If you don't have a LISA account, open one today. Because with a LISA account, every tax year, even if you plan to buy your first home in next 2 years, 3 years, or 4 years, you are getting an extra £1,000 on your deposit. Like, it will help you raise your deposit on your first home faster. Now, come to think of it, if yourself and your partner are now buying this house together and you're depositing £4,000 every tax year, say for instance you still want to buy the house in whether 2 years or 3 years time, you'd probably end up with 4,000, 6,000, or even up to £8,000 extra as part of your deposit. Now, there is a catch to this. You say you have listed 3 ways in which I can withdraw my money. What if I need my money before and I'm not what if I need my money and I'm not buying house? I am not terminally ill, neither am I 60 years and above. What can I do? How do I get my money? Now there is a catch to it. Because the government is giving you 25% on top of your money. For you to take back your money, they would also collect back 25%. Now, before you go too far, if you put in £4,000 every tax year and the government gives you 25%, making it 5,000. So now if you now decide to withdraw this 5,000 in the hope that you'll be getting your £4,000 back, wait, the 25% of £5,000 is 1,250, which is going to give you less than you have put into the account. You probably end up with about £3,750,000. So it is best to put in money for either buying your first home or for it to serve as a retirement fund. Before we close the topic on ISA, I know you would say I've not spoken about the 4th kind of ISA, which is the innovative ISA. When it comes to the innovative ISA, it is the kind of ISA that helps to connect a lender to a borrower. It helps to provide money, like it helps to circumvent the idea of going to banks to borrow money, and it allows investors to be able to provide their money for people who need money. Yes, currently there are a number of companies that offer innovative ISA, but this money, it is not backed by the Financial Commission, which means your capital is at a very high risk. You are at risk of losing your capital, because as much as you are doing it through a company, there is a risk that whoever borrows the money is going to default. Even though the company might have a contingency fund, however, if they have a high number of defaulters, the contingency fund will not be enough to go around to pay every of the investor. Another thing is the fact that you would need a lot of time before you are able to withdraw your money. So for the innovative ISA, the risk is actually quite higher, and that is why I would rather put my money into the other different types of ISA. So to this end, therefore, have £20,000 across all your ISA accounts, and you can decide to use all your allowance in any one of the ISA accounts, with the exception of the LISA account, which has a limit of £4,000. Every tax year, you can only operate one account across all the different types of ISA. Like for instance, you might have a Lisa with nutmeg with money box. However, in every tax year, you can only decide to either put the money with nutmeg or to put it with money box. The same thing applies to the other three ISA. So you can only operate one account every tax year. If you decide to switch provider, you'd have to switch all your money, like all your investments for the year, into the ISA account. Also, you need to be careful and to make sure that you do not exceed your allowance of £20,000, because otherwise you'd have to withdraw this money, and if it's in shares and stock, you'd have to take back this money. If you've had any interest, profit, or dividend or capital gains on it, you'd have to pay tax on it. So you'd have to keep an eye out for this. All right, guys, we've come to the end of the discussion about ISA accounts. Yes, the tax year is coming to an end, so you need to make sure you use your allowance for this tax year. It doesn't have to be everything, but at least make sure you're making use of your allowance, because it is not rolled back into the next year. All right, guys.